what do you see the difference between, I guess, these market darlings and these secure companies that aren't trading on high multiples?
Yeah, look, it goes back to my capital protection mentality, and look, it's ingrained in who I am. But I like to buy companies where I believe there is a reasonable valuation, where the business has generates revenues, has a containable cost base, and makes a profit.
Yeah.
The profit converts to cash, the cash pays a dividend.
Yeah.
Because at the end of the day, that's all that matters. Cash matters, right? And so if as an investor I'm getting a dividend stream, I'm generating a yield, because they pay tax, you're getting a franking component.
Yep.
So I'm getting a return to own that stock.
Yeah, it really is a long-term approach, isn't it?
Absolutely. And then what you do is you want to own a company that can grow revenues, contain its cost base and make more money than it did last year, and then your dividend will grow. Yeah. But equally, the share price will grow because that company is making more money than it used to, and the share price is higher. So you get your dividend yield, it's grossed up for franking, you get a capital component, and you're making an annualised return. And that works for investors who are new to the game because they can take the cash flow and reinvest into other stocks and create more wealth. It works for retirees who want an income stream to live on. And so as an investor, that's what I want.
Yep.
If I buy a stock that's conceptual in nature, startup, losing money, growing market share, trying to achieve market penetration, I've got some risks. The risk is I don't know what the industry is, and if the PE we talked about before is say 50, that means that I would need to understand what I think the industry will be today to when I turn 100. Okay?
Yeah.
So that's the context you need to think about. But in between, for the next 5, possibly 10 years, it isn't making any money. So that I spoke about, where the revenue through cost becomes profit and cash, and I get a dividend, you don't get that.
Yeah.
So what you get is you get a punt on what the industry might look like later in the future. And that's risky.
Yeah.
You know, and it's a little like, you think about it as, if the PE of 50 falls to 30, okay, you've lost 40% of your money.
That's a lot of money.
Right?
Yeah.
And that ain't ever coming back.
Nah.
Right? And so, because someone says, oh, it's worth 50, why can't someone say it's worth 40? And what's happened is, it started out at 20 and everyone went, oh my goodness, this is the greatest thing since finance. Like Afterpay is a great example.
Yeah.
It started, the greatest thing since finance, it's going to revolutionise the industry. It's actually a really good product. So some of these companies have good products.
Yeah.
But it goes back to, what do you pay? And I would always use that term. When you go into a cake shop, you look in the window and you think, that is a nice cake. And then you say, well, what do you say? You say,
what does it cost?
How much is that cake?
Yeah.
Right? You don't go, that's a nice cake, I'll have it. Right?
All comes at a cost.
100%.
Yeah.
So you've got to ask, how much am I paying for high PE stocks? And what is the risk? And I think that's really important, because you've got to be very careful that you don't just get on the bandwagon and want to own these stocks because a lot of people have made money out of it. You need to remember that long-term wealth is created out of capital preservation.
Yeah.
So if you lose your capital, it's really hard to get back, and it's difficult, and you've got to then invest again and start and build that wealth back to where it was before you start to grow again.
Yeah, I love that.